Warren Buffett is dumping stocks. The upcoming stock market crash is pre-planned. Watch before the crash. Warren Buffett is signaling wariness with the soaring share market as the billionaire investor extends a selling streak. Today we're going to talk all about why Warren Buffett is selling his holdings from 2008. So watch the video till the end, because today's video is going to be the bomb. Welcome to Investor Secret, your daily dose of wealth secrets. If you're interested in everything around big investors and their investment techniques, this is the place for you. Subscribe if you want to stay updated with all the investor secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. Mr. Buffett's Berkshire Hathaway was a net seller of equities for the fourth straight quarter, a trend not seen in data going back to 2008. The company ended up selling almost $2 billion more in stocks than it purchased during the period, adding to a cash pile that climbed to a record $149.2 billion. The selling streak indicates Mr. Buffett has struggled to find bargains with the share market hitting record highs. A big, splashy acquisition also eluded the conglomerate as the 91-year-old and his investing deputies confronted a combination of sky-high price tags and fierce competition from the wave of special-purpose acquisition companies. The big issue here is that Berkshire was a net seller of stocks again this quarter. Jim Shanahan, an analyst with Edward Jones, said in a phone interview, "That's the primary culprit of the cash pile continuing to rise." Cutting holdings in banks. Berkshire's sales appear to have largely come from cutting holdings in banks, insurance, and financial investments, according to its third quarter regulatory filing released on Saturday. Berkshire has been paring certain stocks in recent periods, spending the second quarter trimming its investment in General Motors and pulling back on some of its pharmaceutical bets. The company is set to release its third quarter stock tweaks this month. Although Mr. Buffett has been a consistent net seller these past 4 quarters, those sales have been relatively small compared with the huge size of his stock portfolio. Over the past 9 months, he has sold almost $7 billion more stocks than he has bought, roughly 2.2% of the fair value of Berkshire's stock portfolio at the end of September. Doubts about SPAC boom. Mr. Buffett warned investors in May that Berkshire might not have much luck striking deals as SPACs gripped the market, though he also predicted the boom probably would not last. Compounding the challenge, his most recent big acquisition, the $37 billion deal for precision cast parts 5 years ago, resulted in a write-down that Mr. Buffett led squarely at his own door. Berkshire is not alone in extending a cash pile amid the pandemic. Amazon.com, Google parent Alphabet, and American Airlines Group were among companies that amassed significant holdings during the health crisis, in a step analysts have said would probably lead to some acquisitions. And the rising cash pile is better than the alternative in the eyes of investors, including Cheviot Value Management's Darren Pollock. Even though Mr. Buffett's cash pile still increased to a record despite the $7.6 billion of buybacks in the third quarter, Mr. Pollock says it's a good sign about the health of Berkshire. "We're happy with it because the alternative is that the cash isn't growing as much, and that means that Berkshire's operating companies aren't of as high quality as we thought," said Mr. Pollock, whose Cheviot owns shares in Berkshire. To see that the cash is rising, to see that he's deploying so much in one avenue, which happens to be buybacks, it's not acquisitions, but it's being spent in a productive way. It's so much better than the alternative of seeing that cash stabilize or decline without other large acquisitions. Here are some other key takeaways from Berkshire's third quarter earnings on Saturday. Berkshire appetite. Mr. Buffett has increasingly leaned on share buybacks as one way to deploy billions of dollars. He's spent about $51 billion on stock buybacks since its policy tweak in 2018, outpacing the $31 billion used to purchase shares of Apple, Berkshire's largest stock bet. In the third quarter, Berkshire bought back $7.6 billion of stock, surpassing the $6 billion of shares repurchased in the previous period. BNSF's record. Record profit at Berkshire's railroad, BNSF, and strong earnings from its energy businesses helped raise operating profit by 18% at the conglomerate during the third quarter. That also aided in offsetting a painful quarter for Berkshire's insurers. Those businesses reported an underwriting loss that widened to $784 million amid heightened catastrophe costs and worsening claims trends at car insurer Geico. Buffett may be sleeping more soundly, but he missed out on a significant gain. For example, Berkshire's Goldman stake was worth $2.8 billion at the end of 2019. It would have fetched $4.3 billion today. JP Morgan, PNC, and Synchrony are also trading at record lows, while Wells Fargo and M&T have rallied to 15-month highs. Moreover, Buffett didn't sell the banks and buy something better instead. He has struggled to find compelling uses for Berkshire's cash reserves, which exceeded $140 billion at the last count. His company sold about $13 billion of stock on a net basis over the past 5 quarters, and only spent about $4 billion on acquisitions. In fact, Berkshire's biggest splurge in 2020 was spending $25 billion repurchasing its own stock. Buffett risks missing out on further gains too. Bank stocks stand to benefit from the U.S. economy reopening, higher interest rates, a booming stock market, and regulators approving bigger dividends and buybacks in the coming months. In short, Buffett sold his bank stocks well below their current prices, won't benefit from any further gains they make in the coming months, and has been earning a meager return on the sale proceeds. His saving grace is Bank of America. Berkshire's 1 billion shares in the lender have surged in value by 18% since the start of last year to $42 billion today. Buffett explained that Berkshire only approached the decision-making process after it was assured through the Coronavirus Aid, Relief, and Economic Security (CARES Act) that there would be a robust backstop in the markets until both monetary and fiscal policy kicked in. We had an incredible problem. Just as Charlie is the chief culture officer, I'm chief risk officer at Berkshire. That's my job. We hope we do well, but we want to be sure we don't do terribly. We had a few people that wanted to go in for help from the government. They said, everybody's going in for them. Why don't we go in? I said, Berkshire can handle it. This is for people that can't handle it, so we're not applying for it, Buffett said. Buffett agrees with the government aid in general, but wishes it had been more expansive. I think that was fine public policy. I wish it could go to every restaurant, dry cleaner, small business that was out of business and they were made toast basically. But the airlines, clearly what happened was not their fault in any way, shape, or form. It wasn't like in 2008 to 2009. Buffett believes that airline travel isn't likely to return to pre-pandemic levels because business travel still lags. But he underscores the point that Berkshire still has material airline exposure through other businesses. I still wouldn't want to buy the airlines business internationally. People really want to, they want to travel for personal reasons, and business travel is the other thing, said Buffett. We've got a big exposure to business travel, of course, through the fact that we own 19% of American Express, and we own Precision Castparts, which services the air businesses. We've still got a big business investment in air travel, a big commitment to it. We wish the big four the best, and I think our managements have done a very good job during this period. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Investor Secret. Bye!